boring for 6 months. Now I'm having fun. And so this is so existential that I think the trend just keeps going. It keeps staying in motion. And I think it's a really good thing for America. I mean, our dollar's overvalued. It's destroyed jobs here. It's kind of hollowed out the economy. I don't think MAGA is bullish U.S. equity. It might be really bullish U.S. nominal GDP. Trump never really explained what the plan is, but through his actions, you can kind of tell that he wants flyover country to win again. They haven't won in 40 years. And if they have to use tariffs and if they have to do some things that are not so good for corporate America, well, that's okay. He doesn't mind breaking some things. I mean, he's said it a couple times now. He doesn't care, like, if his tweets take the stock market down. I mean, if MAGA succeeds, Manhattan and California and Chicago end up as smoking craters. And, you know, somewhere in the middle of this country is going to boom.
Is it time to increase exposure to international markets? Hi, everyone. I'm Maggie Lake, and today I am talking macro with Harris Kupperman, founder and CIO of Praetorian Capital Management. Hi, Kuppy. It's great to see you. Great to have you on.
Hey, it's great to be back on. It's been a while.
It has, and it's such an interesting time to catch up with you. First of all, how have you been? How are things?
Things are great. Things are always great.
I know you have that attitude, and I love it so much. Plus, you're sitting in the sunshine most of the time, so I think it helps. You get a lot of vitamin D, which is good.
Not really. I've been sitting in this office nonstop trading.
In your gun turret, as we say. But there's a lot. Listen, markets are doing things again too, right? So that's
yeah. It was boring for 6 months. Now I'm having fun.
Exactly. So a lot of people listening know you, but for those who don't or might be newer, just give us an overview on your approach to investing.
So I do what's called inflection investing, or what I call inflection investing. We look at sectors and industries and parts of the market that have been ignored, unloved, destroyed a lot of capital. They give people PTSD when you mention them. And as a result, people just stop paying attention and they get really, really cheap. And we try to show up at a moment in time where things are going to inflect, where things are going to start actually getting better and the share price will go up. And the whole point of this is that, you know, if we get it wrong, we get a lot of these wrong, I get my money back because there's so little built in terms of expectations that I'm buying really cheap assets. And if it works, and a lot of them work, hopefully we're going to make 5 times our money or better over the next 2-3 years. And I know it's going to be volatile. I know it's going to be scary. I know it's going to be weird. But if you buy things for way less than replacement cost, if you buy them at a single-digit cash flow multiple, you buy things with buybacks and dividends where the people behind them are good people, usually good things happen to you. And, you know, I'm a growth investor, but I start from a point of value investing effectively. And that's what inflection investing is.
Yeah.
That's your 45-second pitch.
Yeah, I love it. I think that's really good because it's really interesting. We're coming out of an environment where everyone wants to buy the winners. So it's a very different way of approaching it.
Look, we've had 2 tough years because everyone bought NVIDIA and no one likes my names. And my names are doing pretty okay. And, you know, I think people are going to start buying my names because the past few weeks they have been. And usually when my stuff starts going up, it keeps going up.
So you mentioned inflection points, and we've got a couple of big themes that people are saying we're in a regime change. And I just want to get your thoughts on it. One of them is that there's talk that we're entering a period that favors an actively managed fund. Active management is back over passive. Do you agree, or do you think that's too broad a generalization or too soon to say that?
Look, I agree with you, but if you asked me this question 10 years ago, I would have also agreed with you. You know, if you ask me in 10 more years, I'm probably still going to agree with you. I don't know. I don't know why you'd buy a passive. So here's a funny thing, okay? So this is off topic a little, but I did a little test on my father because he owns the S&P 500. It's most of his retirement savings, right? And I said, Dad, what percentage of your net worth, of your retirement account in the S&P 500 do you think is Tesla? Because he doesn't care much for Elon Musk. And he goes, those 500 stocks is a little bigger, so maybe it's like half of 1%. And I go, no, Dad, it's like 4% of your net worth. I'll make up the number, but it's something like that. And he goes, what? And then I'm like, so what percentage of your net worth do you think is NVIDIA? Like, we both agree this AI thing's a total flop. And he's like, I don't know, maybe if Tesla is like 4%, maybe it's like 1%. I'm like, no, it's bigger than Tesla. It's like 6 or 7% of your net worth. He goes, wait a second, I have like 10% of my net worth in 2 things that I think are worthless? And I'm like, yeah, Dad. There's 20 ticker symbols that are half your net worth, and they're really overvalued. And I think as people start doing this exercise, they're going to have the same kind of shock and awe that my dad did. My dad's too old to be investing in Tesla. And, I don't know what he should be investing in, but it's not that. They shouldn't be buying NVIDIA at the top of the cycle, but, that's what he owns. And I think a lot of people are going to look at this and say, there's a bunch of things I could buy at 5 times earnings. Maybe I should buy some of that. And as that starts and the momentum kind of wears off, I think you see passive underperform as opposed to having performed for a long time. I think active might have his day in the sun, but maybe not. I don't know.
It's like turning the Titanic, because so many people just kind of push it into those 401. So whether it should be the way or whether it will be the way are two really different conversations. But I think it's interesting because of the backdrop we're in. I could see why people are making this case, or at least trying to encourage people like you did to say, like, if you're passive and you're investing in passive things, make sure you understand what you actually own,
Yeah, but then my dad, I don't think he's going to change anything. I mean, what's he going to do? Buy munis? Like, that's even worse than buying Tesla. I don't know.
I love that you didn't sort of give him a pitch for your fund, Kuppy.
He's made enough money in my fund. He's good. He's good to go.
He's taken care of. Okay. So, but you are actively managing. So how are you feeling about the macro backdrop right now?
So I think there's a couple things going on. To start with, and I think this is really important, the U.S. is like this capacitor. Capacitor absorbs energy and it releases energy. It absorbs and then poof, it releases. I think that's what we've been doing for the better part of a decade, 20 years. Like really since the bottom in, let's say, 2009, we've been absorbing the world's energy. All the capital comes to us. And partly this is because our markets are just better companies, higher return on capital businesses, growing businesses. I understand why U.S. equity markets should trade at a premium. Partly this is because of our massive trade deficits where people earn in dollar and dollar tends to appreciate. So they want to save in dollar and their choices aren't very good outside of equities. And they just buy equities. They see the S&P 500 as inflation protected bonds. And, if you look at the yields, I mean, it's not such a bad decision. I mean, it's roughly the same yield and you get, inflation protection. I understand why people would, want to own this instead of 10-year. I mean, sorry, Scott Bessent, but no one wants to own 10 years. And so I understand why the capital keeps flowing and it's, an energy capacitor that's overcharged now and you needed a political change. That's the only thing that'll change it. I don't think MAGA is bullish U.S. equity. It might be really bullish U.S. nominal GDP, but it's going to happen in a way where wages go up and, the percentage of the pie that goes to labor. I mean, Scott Bessent's told you that's what the plan is. Trump never really explains what the plan is, but through his actions, you can kind of tell that, he wants flyover country to win again. They haven't won in 40 years. That's his core base, and he wants to see them get a bit more of the capital. And if they have to use tariffs and if they have to do some things that are, maybe not so good for corporate America, well, that's okay. He doesn't mind breaking some things. I mean, he's said a couple times now, he doesn't care like if his tweets take the stock market down. This is a very different Trump than last cycle where, last cycle, let's be realistic. He would tweet at some television personalities most of the day. He'd get in about 2 rounds of golf, and then he'd tweet about how great the stock market was doing. That was his day, every single day, 7 days a week. And this time he's actually doing stuff. You can agree or disagree with it, but the things he's doing aren't good for equities, and he just seems indifferent. And I think long-term, they'll be great for the U.S. economy and great for the stock market. But if you take an economic system that's built up over 30, 40 years, and you realign it and you say, look, we're going to take our deficits down from $1 trillion a year to some number half that big. And we're going to put tariffs up to do this. And we're going to take the US dollar down to do this. And we have some like big picture steps we're going to do. Well, that's not good for equities. You could have told yourself that. And I wrote a couple blog posts about this. I think MAGA is terrible for equities. And so what you're seeing happening over the last 2 months, is two things. I think one, you're seeing a lot of portfolio managers, okay? Like we all think in a US centric way, but I think a lot of portfolio managers are international. They sit overseas, maybe even some of the big guys like CalPERS, they think globally. They have a benchmark. Their benchmark is every global equity. And for a very long time, they've been overweight US because US has done better. And that's the way you outperform your benchmark. And they've gotten, big salary, big bonus, got promoted. I'm thinking of guys like sovereign wealth funds, central banks, like Swiss National basically, just owns Mag 7 now. I'm thinking of these big pools of capital. And suddenly in the last 75 days, the international markets are doing a lot better than the U.S. markets. I have a list of international markets up more than 15%. Some of them are more than 20. I mean, the U.S. market is kind of unch on the year, but big tech is down 10, 15. So if you're overweight big tech and you're underweight, emerging markets like Germany or, real frontier markets like the UK, which keeps hitting a new high, the real shithole places that no one wants to invest. You're underweight. Like you're down 1,000 bips against your benchmark. And, in prior years, when you're up 200, 300 bips against your benchmark, they gave you a giant bonus. Mm. When you're down 1,000 bips against your benchmark and 75 days into the year, I mean, you're worried about getting fired. And the only thing you know how to do to catch your benchmark is you sit there and pray that US tech has an up day and that emerging markets have a down day and you can reallocate money. And you're so big, you're thinking not single stock. You're thinking, I'm going to pull $1 billion out of this bucket and put $1 billion into this bucket. And you're going to move the market when you do that because you do that every day for the next 100 days. And, you're praying just for an uptick so you can get some liquidity to get a better price. But there's like 100 guys in the same seat as you who are also praying for that outcome. And as a result, it's not going to happen. That's why, these two things are trending and they're diverging. And the guy who was down 1,000 bips, he shows to the office the next day and he's down 1,100, then 1,200. This is against benchmark. You're not allowed to, miss by 50 bips. And so this is so existential that I think the trend just keeps going. It keeps staying in motion. And I think it's a really good thing for America. I mean, our dollar's overvalued. It's destroyed jobs here. It's kind of hollowed out the economy. I mean, it's kind of funny to think about it. The William Jennings Bryan cross of gold? Well, that's NVIDIA. NVIDIA has taken in all the world's capital and it's enslaved, 200 million people in flyover. And as this capacitor releases this energy, these people have a future again. I think it's great. I mean, it's terrible if you own NVIDIA stock, but it's great for everyone else. It's great for people overseas too, because when you think of a guy who sits in Brazil or, that's a country that has a weak currency, it has a weak currency because local Brazilians export, they earn dollars, and they want to keep their money offshore, keep it a little hush-hush, and they go buy U.S. equity. And as a result, there's no investment capital in Brazil. The currency keeps depreciating, which means they have to keep interest rates, abnormally high. They're running like 8% real rate, which is unheard of, even globally, but especially in LatAm. And as a result, business can't borrow, business can't grow. The economy's kind of And that's NVIDIA's fault too. NVIDIA has gone around and enslaved, 7 billion people, 7.5 billion people, and 100 million people in the tier one world that own equities. They're doing great. Everyone else has just been enslaved, and it's finally reversing now. And I think it's a great thing. It's so exciting for me as an investor. I mean, it's really terrible though if you're sitting in Zurich and you run a global portfolio of long equity and you're 1,000 bips below benchmark. But those guys have had a good decade. I'm not crying for them.
Yeah, exactly. And again, if you're managing, you're supposed to be at least sort of looking ahead a little bit, not
you
being
can't look ahead when
everyone's
big.
in.
They're too big.
Yeah,
they're just going to always trail. That they sort of accept that. But like I said, they're supposed to trail by 50, 100 bips, not 1,000.
So you bring up a really interesting. First of all, I love the idea of the sort of energy. That I think that's such a great way to look at it. And your point about sort of trapped capital, not being invested where it needs to be, I think is also amazing. Do you get the sense, because we have seen markets like Germany, Chinese equities, we've seen international outperforming. Throw gold in there too, by the way. But do you think that it's early, that you don't think that big institutional money is even in that trade yet? I mean,
no, sort of. But let's think of your typical, sovereign wealth fund guy. He's supposed to be, he's 50, he's 50% below weight UK because, UK is going through a horrible depression. The guys running it are lunatics, Well, it goes up every day. You can't be 50 bips below. Germany, weren't those guys supposed to live in caves and go hunt mastodons or something? Like, they have no electricity. It goes up every day. What do you do? Italy was supposed to be this museum you go because pasta's real cheap. It goes up every day. What do? You have to buy it.
I'm not laughing at any of the state of, there are some real problems, but your turn of phrase.
The market go up, and your job isn't to analyze the problems. The problems are priced in apparently. And now the markets are going up because all these countries are kind of looking at themselves and realizing they're sort of the laughing stocks of the world. And I'm not saying they're going to fix the problem, but at least they're talking about fixing the problem. And when you start talking about fixing the problem, guys say, this thing's at 4 times cash flow, and maybe the earnings stop declining and MAGA can go up a little. And then you say, why not? Let's take it to 10 times cash flow. And that's happening across all these QSIPs that no one owns. There's no institutional ownership anymore. There's no block. There's no liquidity. I mean, no one even does like research coverage on this stuff. I mean, go to Europe and learn about some of these companies. These SMIDs have no analyst coverage anymore. Like they don't exist. I mean, look, we're long a ton of Brazil. There's no one playing in Brazil anymore. There's nobody. I mean, look at Colombia. I mean, look at all these places. Like, I want to talk about some baskets of emerging markets, but first thing you have to understand this trade flow thing. We're 75 days in. There's a reason why markets trend and why the first 30 to 75 days like sets the trend for the year. And usually it trends for like 2 or 3 years. I mean, I saw this study that if you bought the winning sector on Jan 1, a year after, like 80% of the time you outperform year 2 too. And this is because you have these big pools of capital that never get a chance to reallocate, and they always trail the benchmark. And I mean, look, there's a reason that NVIDIA is basically down every day. I mean, UNCH is the new up for NVIDIA. It's because everyone owns too much NVIDIA, and no one owns any Brazil. No one owns any Southeast Asia. They should. And instead, they own too much semiconductor. They own too much Apple. I mean, like this capacitor is just so.
What's the risk?
I think it's gonna keep going.
Yeah. I imagine there are, folks listening to this and thinking, yeah, like me, guilty, all of us are probably overexposed to some of those names. But the idea of having to turn your lens internationally is probably a little daunting to them. You have a lot of experience in this. I mean, you've done not only emerging market, but like real frontier stuff, I think, what I would consider, remembering our conversation about Mongolia. So, you've got the chops for that, but it's probably a little bit daunting. It's something they haven't had. How do you think about, or what's a way to think about doing this? Is it like everything goes up internationally? Do you have to be careful about how you allocate if you're looking internationally, especially if you haven't been using that muscle in a while?
Well, look, first thing, not everything goes up internationally. There's good and bad stories. There's a lot of in between. That's why you do research. That's why you go learn. There's, fortunately, a lot of ETFs now that didn't exist. The last EM cycle was 2002 to 2000, let's say 8. And then it kind of extended because China did too much stimmy, and it kind of gave a lease on life to a couple of commodity exporters. Let's just call it 2002 to 2008. Back then you had to set up local custody, local banking relationships. Like you had to have local brokers. Oftentimes you had to go and do like an apostille. You'd have to like fly to the airport locally and, have your broker meet you at the airport because you didn't want to, have to clear customs. Like, now it's easier. There's an ETF. It's dollar denominated. They charge you 50 bips. It's liquid. You don't have to choose individual companies, though a lot of them have F tickers or GDRs. It's a lot easier now. I think the first step is just go buy the ETF. I mean, look, you're going to get some good ones. You're going to get some bad ones. You're going to get a lot of middle. It'll roughly track, what the pension funds are doing. The pension funds don't choose individual stocks in Chile. They just buy the ETF. If their benchmark is, 5 bips of Chile, they just go to 5. And I think you're going to see a lot of that. So that's the first step. The second step is go do research. I mean, a lot of these companies now desperately want foreign capital. They want foreign investors. They've been starved of capital to the point where they actually put out corporate presentations in English. And they hired some young kid that speaks perfect English that could explain to you what's happening. And they might not legally have to translate the financials into English, but they do. It's all available. I mean, I remember this is before you even had Google Translate. You'd have to go hire some kid to go translate something for you. And it was translated poorly. Like, it's come a long way. It's normalized a lot. I mean, Google Translate will solve 99% of your problems. Like, I think the playing field's a lot more even now, and which is why this reallocation is happening faster too. I mean, that's why these guys are so far off sides, 75 days in. Yeah. Actually, no, 65 days in.
Yeah. So do you think that the the flows are going to benefit. I mean, it's interesting because we've seen developed markets. I mean, you were joking about the UK being an emerging market, but you see Europe performing and emerging markets. Like they would have been different at one point.
Well, Europe is an emerging market.
Maybe that's the hard truth.
Sorry. I mean, look, we have probably better power reliability here in Puerto Rico than they do in Germany.
It's extraordinary that we're there. What about this whole Ukraine thing? Does that change? Or are you active in Europe? Are you looking in Europe as well? And does that change?
We're long in Europe.
Yeah.
We have nothing in Ukraine. Look, I don't know the answer to Ukraine. I don't know what's going to happen there. It's in the too hard pile, right? We do sure things or almost sure things. Every bet I make is one where when I get it wrong, and like I said, I get a lot of these wrong, I get my money back. If I invest in Ukraine, I don't know if I get my money back.
But what about the implications now, given what appears to be the U.S. rift? Does it change your view about Europe? A lot of people are bullish because they think Europe's going to spend on defense, but it seems like it's still a big unknown with its relationship with Russia.
Oh, I mean, look, Europe is next door to Russia. They might not like Russia, but they have to have a relationship. I mean, cutting off Russia is really dumb. Europe's energy poor, Russia's energy rich. Like there should be a deal to be made, you know? Good statesmen make deals. And they don't have to like each other. They just have to have a deal. Will they spend a lot on defense? Maybe. I don't know. Europe's historically been a giant war zone. It's like the white people's Middle East. Like they like war, you know. They kind of take a little 80-year sabbatical, and I think they might get back into it. I don't know, but look, I don't really know what's best for Europe. I mean, I'd rather them spend money on infrastructure as opposed to weapons. I mean, weapons are the thing that governments spend on that has the lowest multiplier. I mean, it probably has a negative multiplier. I think they could build infrastructure. They could do education. I mean, we know the infrastructure is lacking. I think that's a lot that Europe could do that would be value added for Europe. I'd rather see them do that. But if they spend money on weapons and it creates a lot of jobs and it puts money in the ecosystem, any fiscal is good fiscal. It makes stocks go up. You know, I'm not European. I wish them the best, but I'm not trying to decide what's best for them. I'm just going to watch what they're doing and hope to make some money for my clients. That's all I can do, right?
Do you, when you look at an emerging market or any international market, I know you think Europe is emerging market, but let's just say international markets, are you a top down or do you go bottom up? Like, are you looking sector? Are you looking geography based on some macro conditions? All of the above? How do you approach it?
All of the above. You know, I'm an all of the above guy. Look, I've been investing in the U.S. now for 25 years. I have a lot of friends in the U.S. If I ask a friend of mine, hey, what do you think of this company? There's a good chance they know all the dirt. You know, I could kind of selectively ask, hey, I think this guy is going to know this sector. I don't have that in overseas. And I don't have that level of trust with management teams that I know they're good people, you know. International markets have a long history of stealing money from guys like me. And so, you know, I'm very skeptical. And so we don't take as big of positions in individual names. We tend to do more basket approach. It tends to be more top down. You know, I think with certain regions that are going to do very well. I tend to focus on more financial assets. I just tend to think that those have more leverage to fund flows. You know, we tend to buy brokers and stock exchanges and things where you need a certain level of trust to gain market share. And they tend to get fund flows because foreign guys usually end up throwing capital at it. And so that tends to be just where I focus my attention. I mean, we own some small cap businesses that are doing idiosyncratic things, but it's really a top down. It's always been how you approach emerging markets. I mean, the two things that work in emerging markets is, and it depends which market, is consumer. You know, you go buy the Coca-Cola bottler. That's the most, obvious thing. You assume, Coca-Cola or Nestle, whoever it is, has proper corporate governance, maybe. And, if the economy does okay, the consumer does better. And, I believe very strongly in S curves, which means that as per capita income goes up, they consume more Western quality stuff. Well, I don't want to say quality. That's the wrong word. Actually, it's actually poisonous for them. But they consume more Western stuff. And so, you buy the Coca-Cola bottler, you buy the guy who has the KFC franchise. Like those sort of things have historically done really well with good corporate governance. And they tend to get high multiples near the end of the cycle. So you get earnings growth and multiple, which means you get, multi-bagger upside. And that tends to be where I buy, but gun to my head, I'd buy the stock exchange every day of the week. I mean, let's talk about Latin America real fast, because I think it's a unique story. Latin America historically does like 20 years of communism, 20 years of military dictatorship, communism dictatorship. They've now tried democracy for a change. And it's kind of been this weird middle road of like communism, like, but not full communism. And each of these countries has been kind of mired in its own problems. I mean, talking about the big countries, on one extreme, you have like Argentina, which has been historically a disaster for 100 years. On the other extreme, maybe you have Chile, which have probably done the best. They've all had this election cycle, the current one, except for Argentina, they've gone hard left. And so the economies have been terrible. People are miserable. Things aren't going very well. They tend to be commodity exporting countries, which also is bad because the global economy isn't very good now because the commodity prices are low. And what's interesting is that they're all going right now. So you saw Milei. He inherited probably the worst hand in poker possible. He got the 2-4 offsuit and is making the best of it. 2-5. He's making the best of it, right? And I think he's done really good with a terrible hand. You look at what's happening in El Salvador. I mean, that's even a worse hand. It was a war zone, and Bukele brought peace, and now hopefully he can build the economy. I think bringing peace is really hard. Building an economy is easier. But you look at what's happening as those two are role models now for the rest of LatAm. They have huge approval ratings domestically, but also in the rest of the Spanish-speaking world. And you look at Chile, Boric's going to be out. You look at Colombia, Petro's going to be out. You look at Brazil, Lula's going to be out. Like all these people are polling terribly, and Peru is going to go right also. These are the really large blocks. Uruguay went center left, but that's not really terrible. I think you're going to have a continent that goes right, and it's a commodity continent. It's going right at exactly the time when China and Europe are stimulating. They need some commodities. And LatAm trades a lot with LatAm. And so I think you'll see a lot of domestic trade too. I think the economy's going to do really well. But I think the real important thing is that, remember the cross of gold. When the Dixie is 105, emerging markets do terribly because their cost of capital is too high and they can't reinvest and they just buy NVIDIA. Trump desperately wants the Dixie, I don't know, maybe not 70, but 85, 90. I think he'll be able to get it there. And if he does, well, then your cost of capital goes down in LatAm. People go sell their NVIDIA and they reinvest domestically. And I think it'll be this really reflexively self-fulfilling thing for the whole region. I think you should buy, all sorts of CUSIPs there. But going back to my stock exchange thing, I mean, the Brazilian stock exchange, B3, is a top 10 stock exchange by trading volume, by market cap. You could buy it at like 10 times earnings. I think the earnings are going to go up a lot if Brazil recovers and foreigners like me start buying Brazilian stocks. This huge operating leverage. They buy back, I don't know, 50 bips of the shares outstanding every month. They pay you a dividend. I can see a scenario. I'm not saying this is like my best case scenario or most likely. I can see a scenario where the earnings double and the market multiple goes to more of a global market stock exchange multiple, 20 to 30 times. And you maybe make 4 or 5 times your money. Maybe you get some currency appreciation. I mean, things could be really good. I mean, I could build you a scenario where it goes at 10 times, but I don't want people to laugh at me. But look, they've just been through the ringer in Brazil. And look, it could always get worse, but how much worse can it get? I mean, you're buying something at 10 times earnings, like that has a 10%, annual shareholder return, half dividends, half buyback. Like, I don't think I'm going to lose too much. Maybe I'll lose 10%. And so you look at these sort of scenarios and it's just like, gimme, like, I want more, And I think if LatAm works, I think, the interconnectivity of the stock exchange, the fact that, companies that are listed throughout LatAm, I mean, it's great. It's a Colombian stock exchange, but there's no liquidity. What's the point of trading there? Like, these guys are all going to want to get, dual listed. I just think there's a lot of things that can go.
So they're going to want to dual list in Brazil.
Brazil is a likely option. I mean, there's a lot of Brazilian equities that trade up here in the U.S. I mean, I think the liquidity goes back down there. I think they do a bunch of privatizations. I think there's a ton of things. Like, what we've learned about stock markets is that second, third tier stock markets have no liquidity. Equities get the best multiples when they have the best liquidity.
Yep.
I think they're going to find liquidity there.
That's so interesting because, we always thought of Hong Kong when anywhere in Asia, right? Everybody listed on Hong Kong.
But of course, because you want the most liquidity.
Right, but you don't really have that corollary right now, but you're suggesting maybe Brazil could be that. They have a really robust banking system too, don't they?
Yeah, I mean, look, it's like four banks. So it's like kind of an oligopoly, right?
Yeah.
And but look, it's actually a functioning country in many ways. They just have a madman running it, and he's trying to do communism. And I think the vast majority of Brazilians just kind of like get on with their lives. They look at Argentina next door, where things are getting better, noticeably better, month by month. And Argentina was always kind of like the country you make fun of. And
Right.
suddenly, they're running laps around Brazil, and people kind of looking like, we
Wait a
want
minute.
some of that,
Yeah. What can LatAm do well? I mean, any emerging market, I guess you could ask this question. If the US is in recession and weak, because if you have a stock market that's going to see capital flows out, and you've got an administration that's willing to, I think Besant called it detox, is now what they're saying. But
I like
cause
that. I like that
pain.
word. I
Yeah,
think
cause
it's an
pain to
accurate
sort of
description of what needs to happen.
rebalance some things. If you've got a U.S. economy sucking wind, can people outperform around that, or is that
Well, that's the whole point. I mean, we're going to release capital here, and the Brazilian FX, it's going to stop, tapping on 6 and maybe, strengthen this to 5.5. And then they don't have to keep the interest rate so high at the central bank. So they can take the real rate down from 8 to maybe something more like a 3 or 4 historic rate. So it's 500 bips, lower borrowing costs, which means that companies, don't have to spend all their EBITDA on interest coverage. They can start reinvesting instead. Like, give this really virtuous cycle. I mean, Brazil is a giant domestic economy. It's not just an export business. I mean, everyone looks at Vale and they look at Petrobras, but there's a huge domestic economy too. And high interest rates slow that all down. And yeah, look, as an export economy and a commodity economy, a weak U.S. isn't always that helpful, but it's not like we're importing a lot of iron ore from Brazil, like it's really tied to China in a way.
mm.
And I think
Well, there are
China,
questions about China too. I mean, do you
well,
have to have a view on China if you're going to think about?
yeah, you do. I mean, I have a view on China. Xi tried austerity and it wasn't very fun. I don't know if he wants a raging bull market, but I think he realized that he wants to put a floor under things. And look, we're long China. China has done very well for us. But I think we're more in the mid cycle now, where you start thinking about where you want to start peeling some positions off, just because it's up so much. China's always a rent. You don't hold China. And so it's had a run. But I think Xi has kind of put a floor under things and has said we need some real growth here. And that's really good for commodity countries, because you have over 1 billion people that are, going to see economic growth as opposed to really slow growth. And then China trades with all of Southeast Asia. It should be good for them. It should be good for, everyone, really. We've had this weird moment in time after 2022 where the U.S. said, okay, we have too much inflation. We're just going to, stop everything, take rates high up and stop everything. And we had been the engine of growth the last 5, 6, 7 years, because China, they had their crackdown on growth, earlier, and then they did the whole COVID lockdown thing. And so China was kind of non-growing. And then Europe's been doing this weird woke climate communism thing, which I don't really understand. But, they sort of brainwashed everyone into the idea that they're going to, bicycle around and save the weather. And I don't know. I mean, I've been to Europe. It's funny, and you see a bunch of guys in Denmark on their bicycles, and it's freezing cold and the weather's crap, and they just love it because, they're saving the weather. But, Europe decided this was the future for them. And as a result, they've had no economic growth for 15 years. And so you had like the 3 main centers of economic growth that all shut off. I mean, in Japan, it was in a mess too. That's the 4th one. Well, Japan started waking up first, but Japan can't work when the other 3 are asleep. China seems like it's waking up. Europe, I guess this week decided they want a different path. I don't know what that path is. It might just be more woke communism, but they are at least doing something with fiscal. And Trump, I think, really wants to see nominal GDP growth here. And it's going to be a little messy and bumpy as he reiterates the entire U.S. economy. And, I wish I could tell you I knew what his plan was, but I'm not sure he fully understands, all the steps along the way. He seems to kind of be just winging it. But I think he knows where he wants to get to, which is half the battle. And so I think you see the world kind of waking up again. And that really should be good for commodity exporters. It should be good for everyone, actually. I mean, you want to be long nominal GDP. It'll be an inflationary nominal GDP, but I think it'll be, net good for, prosperity.
Yeah. I mean, it's funny because it sounds like a very hopeful message, but there have been people who agree with you. I talked to Juliette DeClercq last year, and she was saying that this kind of shock to the system might be the rebalance that's needed for all the reasons you just laid out. But the interim to get there is very dicey, right? Like there's potentially a lot of pain. And I think that people wonder, and the fear is that, does something break? Does something
Probably
go right? A lot of things maybe. And can that sort of derail the whole thing? Like if you've got some sort of crazy systemic event that happens out of that, and does that cause,
Well, I think you're going to see a lot of things break. I mean, look, we've had a world where people thought you could, value commercial real estate at a 2 cap and borrow money at 1.5 and somehow make the math work. And now that piece of, cement is worth a 7 cap and it doesn't work anymore. You have negative equity. People, the whole generation of people my age, a little younger, decided they didn't want to, finish college. They were going to go build dog walking apps because SoftBank would give you $1 billion for a dog walking app. And suddenly those guys probably have to go get real jobs, but the real jobs aren't tech programming. I mean, America's short on welders. Like those guys have to go back to university and learn how to weld. And if you learn how to weld, you're not going to get 1 million stock options that might be worth $1 billion. You're going to end up having a middle-class home. And, I think there's a lot of people with very aspirational mindset that might not be fulfilled. I mean, they might be very happy. I mean, my parents are middle class; they're super happy. But I don't think you get that. That, oh wow, SoftBank bought us for $1 billion, and I'm 26. Like, I think that world is ending now, and the world now needs earnings and cash flow and producing things that people actually want, as opposed to things you could just dump on the stock exchange. Because, like I said, MAGA is bearish stocks, and if the S&P goes from 6,000 to 4,000. Not only, do valuations drop by 1/3, but the incremental dollar probably doesn't go into, hyper speculative tech things. It goes into things that produce cash flow and produce things that we can sell and barter with the rest of the world.
Yeah. Someone said to me, the money's moving away from Planet Palo Alto.
Good. I mean, if MAGA succeeds, Manhattan and California and Chicago end up as smoking craters. In Washington, D.C., that's the one that is the biggest smoking crater of them all. And, somewhere in the middle of this country is going to boom. I think people forget that in, say, 1975, Manhattan was bankrupt. I mean, New York City was bankrupt. And Dallas was the center of all economic activity in the United States. And it took about 40 years for the center of gravity to move fully the other direction. And now the center of gravity might just go back. Maybe it's not going to be, Dallas. It's going to be somewhere else. Maybe it ends up being Austin, or maybe it ends up being some city that hasn't even been identified, with 100,000 people. But I think the center of gravity is moving away. And if MAGA succeeds, those coastal places that have prospered on cheap credit and the ability to pump and dump speculative ventures onto the stock exchange or lever up assets like private equity, I think that world disappears. Like that goes away. Those guys will all get shredded. And the guy who produces something useful that we can sell overseas is going to do really well.
It's so interesting because this is the first time that anyone's mentioned the psychological shift. I mean, everyone decries the gutting of the middle class. Many of us grew up middle class, and we sort of people understand in some fundamental way that has disappeared, and that's a negative thing. But no one's really asked, is everyone ready to go back to that? That's a change, as you said, because even if you're not, I mean, there are very few number wise of those people who are getting their apps bought for $1 billion from SoftBank. But the idea that you might be able to do that is it's kind of that like 10x or go home. It's the reason people trade crypto, right? Is that they want to get rich.
Well, that's a whole different story. Let's leave crypto for a different interview.
You know what I mean? It's that YOLO idea that like, I gotta hit it big, or what's the point of even trying? Everyone's gambling on their phone for that same reason, So psychologically, are people going to be content with a middle class? I don't know that I've ever heard anyone ask that question before.
Well, I mean, they can still do speculative things in their free time. or you find the new thing that the world needs. Look, everyone doesn't have to be doing venture capital all the time. I mean, people need to produce stuff that the world needs. I think the bigger question really is like, look at the Mag 20 or Mag 50, whatever. The stocks go up every year. And so as a result, they don't have to pay the employees. They pay the employees some de minimis, cash salary, as little as they can get by with, and they give them stacks of stock options. And as a result, these companies show huge amounts of cash flow, huge earnings because it's always, X SBC. And suddenly, if the stock stops going up for 2 years, well, how do you incentivize these people? How do you, retain these people? These guys are used to being, you work at someone like a Microsoft, you're used to making, some huge amount of money, and 75% of it is stock options. And suddenly you say, I don't really want stock options. I want cash. Like, I can't buy groceries with stock options. I want cash. And suddenly all these companies stop being as profitable. And I think that's a bigger change.
Let me ask you about something you said before, since we're talking about technology. You think AI, you don't believe in the AI revolution. You think this is overstated? The stock value of NVIDIA aside, and the overvaluation there, just the AI in general, you're not buying that?
Look, AI is going to make everyone more productive. It's an interesting technology. In certain industries, it's going to be very important. In some industries, it's going to be, inconsequential. I think of AI very much like Microsoft Excel. I can't for the life of me manage to contemplate a world without Microsoft Excel. I have models. I use it all the time. It's super useful. I don't pay anything for it. We have a Microsoft license, probably 7 cents a year of our Microsoft license goes to Microsoft Excel. It's not really like a profit center for Microsoft. They've done zero to make it better. And that's because there's Google Sheets, there's 10 other free versions. So it's a non-profit center with multiple competitors offering the exact same product. And as a result, it's kind of an afterthought. It's huge productivity gains. There's no revenue. And you can't have a business without revenue. Look, there's like 30 of these things now that are pretty good. It's probably a couple hundred I've never heard of. Do you use ChatGPT? Do you go to, Grok? Do you go to, Perplexity? It's all free. I mean, all they want to do right now is, Kuppy used my product. We're worth more. Kuppy used my product the second time today. We're worth way more. They're just trying to raise more money. And I don't see how that ever changes. Because there's no revenue. And if you charge me to use it, I'll use the free one. And that's the trap they're all in. Mm-hmm. And look, it's good. It's not that good. It'll be better in 2 years. I get that there's, flaws, and sometimes it gives you gibberish back. But I understand it's evolving. It's going to be a better product. But I don't know who pays for it. There's something like $500 billion gone into this. And I think ChatGPT has $4 billion of revenue and at a negative gross margin. Like, that's the entirety of $500 billion. And it's not even growing very fast anymore. It's kind of, stalling out in a way. I think it's just an economic disaster for these guys. I mean, the new AI race is going to be the race to get out of data center contracts. Like, that's the AI race in my mind.
That's good. Again, trouble for that sector. So,
look, we're short. We don't short very often, but we're actually short.
Really? You feel that strongly about it?
Oh, I think these things are going to lose 80% of their value.
So across the whole AI space, or is there anything that?
I don't want to name some names. Yeah. It's a tiny little. We don't short much. It's a passion project more than anything else.
A passion project. So let me ask you. So in this situation, when we're talking about you really thinking a lot of the opportunity is in this big shift that's happening and internationally, and the kind of rebalance of the global economy. I know that you're not afraid to weather volatility and stick with an investment if you have a high degree of conviction, or you've done your work and you feel that. But how do you manage in an environment where there seems like there is so much uncertainty? How can you decide? How do you do that? Do you just keep your time frame short? Do you stay nimble? Because you're bullish China right now, long China, and you're interested in Europe, you're playing in Europe. I mean, I've had conversations with people in the last 2 weeks who feel like Europe will not survive this. They will splinter. The European Union's done. And that China has so many off balance sheet liabilities and they are so overexposed on the real estate bubble and their people are that it's like this huge anchor and it's hard for them to navigate. And so there seems to be such an unknown in how this rebalance will play out and who will get hurt, who will thrive. How do you manage an environment where there seems like there is so much uncertainty?
You just show it to office and expect to be down a lot. And when your expectation is, Trump's going to tweet something and I'm going to lose 10% of my portfolio, when that's your expectation, because that's a realistic expectation, well, then every day is a better day because it's usually not as bad as you worry it might be. Look, investing is volatile. We've had this weird world where realized volatility has been super low for a bit. And, Trump's a madman with an iPhone and it's going to be more volatile now. But look, there's going to be an election in Brazil in Q4 of 26. It's highly, likely that Lula is not the winner. It's actually likely that he drops out of the race sooner. I mean, he's not in good health and his polling is abysmal. The day Lula steps away, Brazil's going to go up limit for like a week. Like, I need to outlast Lula. Like, I don't care about Trump. Europe, I think they've kind of realized that you can't run a modern economy without electricity. They're going to find a solution. It's going to be good. Stocks will go up. I mean, Trump will probably kind of poke him in the eye a couple times along the way, but you kind of know where it's going, and it's just going to be a really volatile world. And I don't think you can get caught up in the short term. I mean, I look at my screens all the time, and every 30 minutes it all moves really fast, and I go, "Oh shit, Trump tweeted again." And I grab my iPhone, I gotta go find a stupid tweet, and then be like, "Oh yeah, this is dumb," But like, you just kind of get used to it. I think eventually the world will just get used to it. I mean, we went through 4 years of this last time. By the end of it, we were really dumb. I mean, look, we chose a dead guy as president because we got sick of it. And now I literally miss the calm, sedate hand of Joe Biden. He woke up, kind of pooped his pants, went back to sleep, like nothing happened. And I kind of miss that, compared to this frantic activity now. And I'm not making a political judgment. I think actually Trump's going to get the country into a better place than Biden. I mean, Biden got us into such a mess that you need someone like Trump. But there's a way to accomplish these goals that's, I think, less chaotic. But I'm a trader and I live on volatility. And I'm not saying this has been bad for me. It's been actually quite lucrative. But I don't know. We're 2 months into the Trump presidency and I'm ready for vacation.
I know. I think a lot of people feel that way. I don't even know what's going to happen this summer. Can people even take vacation given the news flow? I mean, I think we're going to have to time it around Washington's vacation. So the devaluation of the dollar, how do they get that? You mentioned they want the Dixie around.
Just a lower number.
Yeah, a lower number at least. How does that happen? How do they achieve that?
I mean, the first step is you just make everyone hate us. I mean, imagine you're running the Swiss central bank and you own a ton of Mag 7, or you're running, the Norwegian oil fund. And there's people that come up to you and it's like, why are you guys overweight oil? Why are you guys overweight the US? That place has gone totally rogue. I mean, it's like Idi Amin's in charge, like we need to, take some exposure off. Let's go back to benchmark because that place is a little crazy over there. And, you're going to wake up one day and Trump's going to be like, we're going to have we're going to have A bonds. And that's for Americans. We're going to have C bonds for the Chinese. We might not pay them interest. We're going to have E bonds. Maybe we'll pay the Europeans, but they have to play ball. Like you don't think that tweet's coming. And so I think people want to get out in front of that. And that's why you see not just equities, but you see bonds dropping. Yeah. And it's all moving kind of together. I mean, bonds have rallied lately in the last week or two, but I mean, I think the trend is down. And I think that's people trying to get capital out of the US. And that's how he's going to get the dollar lower. All the foreign money. I mean, go back to the Brazilian guy. He makes money in dollars, exporting a product, keeps his money offshore, probably puts it in a Swiss bank or, Cayman Corp. And he goes buys NVIDIA. And suddenly he's saying, maybe I don't want so much, US asset. And so he sells his NVIDIA. He has dollars. Maybe I don't really want dollars anymore. I'll go buy some euros. I'll go buy, a nice vineyard in Spain, or maybe I'll even bring the money home and invest domestically. And I think that's happening across millions of people that move capital. And that's how you get the dollar down. And maybe there's some method to this absolute madness of his.
I think that people think that, but then there's the risk, right? We don't really know. I mean, like, there seems to be an awful lot of faith being put in Scott Bessent and how, like, this idea that the people around him have a plan and they know what's happening. But
Well, Scott Bessent is the only adult supervision in the room. So let's hope there's a plan. Sorry, I'm really skeptical and jaded.
that's why we love you, Kuppy. we all need a reality check for sure. Do you does inflation come with this? Are we looking at a
Yeah.
period of higher inflation in the US?
Yeah. I mean, look, I think Trump and Bessent are saying two different things. Bessent keeps saying he wants to outrun it. He wants to basically run nominal at a higher rate than the deficit. And as a result, deleverage over time. He wants to run, I don't want to put words in his mouth, but let's run 10 nominal. Let's keep the deficit at 7. We're going to have 300 bips of deleveraging. And over 4 years of this term, we're going to take, debt to GDP down by 12 points. I think that's how he thinks of this. I don't really know how Trump thinks of this. Right now he's throwing hand grenades around, but I think that they kind of have a similar view. And if you're going to run 10 nominal, and let's say, ignore what the inflation rate is. I don't believe the number. I mean, they tell me it's 3%, but, I want to sign up for that program. I mean, we just redid our health health plan for the employees, and they raised it 8% on me.
Mm-hmm.
I want to sign up for that 3% healthcare. But everything in my life is up like 10, so I don't believe this 3, but let's just go with it. If you're going to run at 10 nominal, you're going to have some inflation. If you take the dollar down and you're going to have some tariffs, well, then everything you import, and we import a lot, is going to cost more. Offset by some efficiency gains as they get government regulations out of the way and hopefully make things, function a little better. But overall, I think, step one is probably going to be a reorientation and a slow down the economy. And then they're going to look at an acceleration probably start 6 months from now. I mean, there's midterms. They can't, wait too long in the reacceleration. So sometime this fall, we start reaccelerating, and it's going to be inflationary. I mean, it's inevitable, and I don't think that's a bad thing. I mean, in some ways, inflation might be the cure for what ails us. I mean, think back to 2022. Inflation, they said it was 8 or 9. I mean, I think it was more like 15, but it felt really good. Every company was beating earnings. You talk to people and things are busy. Restaurants are busy. Everyone's happy. A little bit of inflation isn't a problem. I mean, it's terrible if you locked in, a bunch of, 5-year debt at 150 bips on your commercial real estate at a 2 cap. Mm. It's really terrible if you're Blackstone and suddenly you have to start giving wages, wage growth to people. I mean, think back to what happened in 2022. Blackstone went and complained to the Fed because they're all buddies. And they said, look, we're not going to hit our IRR target because all the wages, all the peasants want wages growth. We're going to miss the target. So they slam shut the economy. And look, they fought inflation, but I'm not sure if inflation is really the problem. It's just like another, fact of life.
Right. But if you're going to be able to survive inflation, you have to have wages. Like, the sequence matters, right? I mean, I know that Trump wants to reconstitute the working class, middle class, get jobs back. But if you don't have those wages, that'll feed inflation. If you're not getting that right away, then it was what everyone went to the polls for, because they hate inflation, right?
No, people don't hate inflation. People hate when their wages don't keep up with inflation.
Right.
Inflation isn't the problem. I mean, look, Biden did surprisingly well in the midterms as a very unpopular president. That's because the economy was doing okay. He did surprisingly well, versus historically a midterm, first term president, because the economy was good. And that was with peak inflation. It was when they imported 20 million migrants and, clamped down on everyone's wage growth that everyone got grumpy. What Trump's doing when he closes off the border, and maybe some deportations, maybe not, is that you're going to see wage growth for the bottom third. And I think that's really great for America because they're the ones with the highest propensity to spend. I mean, if you gave me capital, I wouldn't know what to do with it except buy QSIPs. Like, there's nothing I've run out of capacity to consume anymore. And, I'm in a special place. But I think, the average person, if you give them $100, they're going to go out to dinner. And then that's going to be money in the economy that recycles and recycles. And that's what we saw before. And that's why the economy did so well, because people were getting on the bottom third, were getting wage growth. And I mean, look, it's annoying for people at the top because, your cleaning lady wants a bit more money and you go out to dinner and it's crowded and you have to get a reservation. Everything costs a bit more. And it's kind of annoying for the guys at the top. And that's why they went and, complained to J-Pound. They said, look, we're not going to hit our IRR. And by the way, little Timmy's middle school just went up 30 grand a year.
Yeah.
And, that's the thing that, controls the economy in a way, but no, I think what Trump's going to do will create a lot of economic growth. I think it's going to be really messy. I think you need to reset your mindset of how the world's going to work. It's going to work a lot more like in the 1950s. And, dog walking apps weren't the thing in the 1950s. America made, stuff that people wanted and that we wanted domestically.
And everybody remembers different world. Really good times.
It was a great time.
When we're talking, and we'll close the circle on this, when we're talking about this big flow internationally and capital reallocating elsewhere, everywhere in the world, maybe, two things. Is there someplace that you don't like, or an area that is just a no-go for you in this reset?
I think there's a lot. I don't want to make any enemies. I like people from all sorts of places. These countries that are on the wrong side of the cycle, and they need to come back to the right side of the cycle. You just, a lot of this is driven by politics. For better or worse, very socialist politics get you reelected, but then they leave, everyone mired in poverty. And that's why the next guy comes in, goes to the right. And that's why countries tend to, every election cycle, swing back and forth. You find a nice middle balance, which is fine, but during the, 4 or 6 years you go left, you want to avoid. And the 4 or 6 years, you basically want to buy it about a year before it swings. Yeah. And, you kind of accept that. So this country's going the wrong direction. You stay away. There's a bunch of no-go zones where there's no rule of law, or, it's usually no liquid stock market. So it's a fine also.
Right. So it's not going to be on the sort of where most people would default to. Then the next question is, do you still have exposure to the US, or are you really leaning on the international side of things and think the best opportunities are there? Or do you also see opportunity in the US, just maybe in different places than it would have been a couple of years ago?
We have some US. We've taken it way down. There's some businesses here that I think will do quite well. There's some things where, look, they're really good businesses. They're maybe not doing so great right now. They might do a little worse next quarter. And look, I think if they turn things around starting Q3, because remember, there's a midterm, they have to turn around. I could suffer through 6 bad months because I think on the other side, it's really going to look pretty. And I'm probably going to average down. But these are businesses that are, some of them doing kind of mediocre. Some of them are doing quite well, even though it's a little bit tough. I'd say in the US, it's more for us now to look for opportunities, stuff we want to buy this fall. I think we're going to have a little baby growth scare, call it a recession. I don't know what you want to call it. And I think there's going to be a lot of things that are really levered to the consumer. I think the lower third consumer does really well, and I want to own that, but not yet.
Timing is everything. Kuppy, it's always great to catch up with you and sort of get your worldview, and appreciate you pulling out the lens, because it's so easy to get really sucked into the headlines right now, and they're coming fast and furious. And I feel like everyone just feels off kilter because of that. So it's really nice to be able to talk a little bit big picture and how you're kind of shutting out the noise and how you're thinking about the world. So I appreciate it.
Thanks. Thanks for having me on. It's no one usually wants to hear what I have to say. So I'm honored someone asked me.
I don't believe that at all, but thank you.